Hey y'all, welcome to my first attempt at a new segment. I have no idea what to call it right now, but in due time. The rules of the game are 5 to 10 of the biggest topics circulating online and through traditional news. Each one will be covered in no more than 60 seconds, give or take. So what kinds of topics? They can range anywhere from the stock market to the economy to personal finance to interesting business developments. Basically, boom, 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 and send you on your way. The ultimate goal is to give y'all some weekly news with a little bit of my opinion and hopefully open up some good conversation. So with that, let's get started. Warren Buffett continues to prove why he's the greatest investor of our time. While most of the market was riding the waves of AI and the hopes of softer Fed policy, Buffett was selling out of his stock positions and building up his war chest of cash. The move he made that shocked a ton of people was selling off 50% of his stake in Apple. Buffett has been a long-time believer in the company, but because of his value investing style, he had no choice but to take profit as Apple and other tech look to be overvalued. Warren also seems to be signaling to the world more pain in the stock market is coming. I couldn't believe this myself, but he currently holds more treasury bills than the damn Federal Reserve. How much more? Almost $39 billion more. Insane. The Fed decided to keep interest rates unchanged for now, but strongly alluded to a rate cut in September. This was pretty much in line with the market's expectations, and considering the latest jobs report was a complete dud, market bets are treating a September cut as guaranteed. Whether the cut will be a quarter point or half a point depends on where inflation stands over the next few weeks. So yes, the job market is starting to show some weakness, but what the Fed absolutely cannot do is reintroduce inflation by cutting too aggressively. Outside of the job market, a rate cut is good for financing like mortgages and auto loans, good for stock valuations too, but also consider a rate cut lowers the interest you're earning on high-yield savings accounts and any bonds you decide to buy in the future. So, good for borrowing, bad for saving. Speaking of mortgages, rates on those bad boys are starting to come down to the lowest levels of the year. According to the Mortgage Bankers Association, the average 30-year fixed-rate loan fell over a quarter percentage point. This led to an explosion in refinance applications, now almost 60% higher year over year. 0.25% doesn't sound like a whole lot, but in the context of mortgages, it can be the difference between hundreds of dollars a month and tens of thousands of dollars of total interest paid. For all those homeowners with 8% mortgages, this has got to be music to their ears. Housing is still pretty unaffordable. Because of the issues with the housing supply, there hasn't been any significant pressure on housing prices. Even though higher interest rates would theoretically move prices down, there's just too many homeowners on the sideline with 3% mortgages. McDonald's and other fast food chains like Burger King are in a battle to win back the customers they pushed away with insane prices. I'm sure many of you have ordered or at least seen the $5 value bundles offering a solid amount of food for a fraction of the cost. These companies are finally acknowledging they may have pushed too much of the inflation pressure onto us. Let's be clear about this, though. They didn't introduce these deals out of goodwill. They're trying to reverse a slowdown in sales they haven't seen in quite some time. McDonald's same-store sales fell in Q2, and the parent company that owns chains like Burger King and Popeyes also failed to hit their sales expectations. They must be worried about Q3 too, because most of these deals are being extended for the next few months. A good thing for us is that we may see these chains drive up the total value of future deals as they compete with one another for our business. This one is a little outside of my typical content, but Logan Paul found his way into the investing space again. And not in a good way. Credit to CoffeeZilla, an excellent journalist, for bringing this story to light in spite of a lawsuit coming from Paul's team. Logan co-founded Liquid Marketplace that allows people to fractionally own valuable collectibles, and that ownership claim is through crypto tokens. The headline, though, is that the Ontario Securities Commission alleges Liquid Marketplace has committed fraud and misappropriated investors' money for personal gain. So, what constitutes fraud in this case? Well, the company allegedly failed to properly mint tokens and authenticate the collectibles customers paid for, while failing to disclose the full spectrum of risk buyers were exposed to. The takeaway from this is a cautionary tale. The crypto space is still fairly unregulated and has very few investor protections in place. If you're going to buy crypto, blockchain products, and alternative assets in general, please understand the extremely risky nature of it all. Losing money in situations like liquid marketplace is not uncommon. Credit card debt continues to hit records. American households owe a collective $1.14 trillion, according to the Fed's latest report. Over the last few months alone, debt balances grew by $27 billion, and a higher percentage of people are relying on credit cards to make ends meet. Credit card debt really took off in 2021 following the pandemic. The sharp rise in spending, coupled with a sharp rise in prices due to inflation, blew debt balances out of the water. Throw on top higher interest rates, and you have a situation where the speed at which balances are growing is exponential. There's tons of mixed signals on whether the economy is strong or not, and in my opinion, the level of credit card debt we're seeing raises the question, is the current economy propped up by high interest consumer debt? If yes, it might not take much to trigger a contraction or even a recession. All right, let's round this one out with a stock market recap. We opened last week with a pretty significant dip in the S&P 500. The weak jobs report seems to have been the cause. The index declined about 6% over a 4-day period, flirting with a full-blown correction. But while some investors were selling their stock positions out of fear, others saw this as a buying opportunity. And buy is exactly what they did. The S&P 500 did a 180 and closed the week up almost 4%. And although it wasn't enough to turn the 1-month period positive, if you zoom out year to date, the S&P 500 has returned more than 12%, which is exceptional. The main takeaway is the short-term movements of stocks are really unpredictable. One day you're on the verge of a correction, and the next day you're beating the average historical return. So to panic sell your assets, only to buy back in at higher prices, is the biggest pitfall you need to avoid. Long-term perspective, y'all. Okay, that does it for this one. Hopefully y'all learned something new or at least got some entertainment out of it. If you like this type of video, be sure to like this video and consider subscribing if you aren't already. If you have any questions, leave those in the comments or feel free to email me at askalexherrera@gmail.com. As always, thanks for watching. Until next time, take care of yourself and best of luck.